Hello again, everyone, and thank you for joining us on today's webinar. My name is Mindy Gare, and I am the Southeast Region Business Development Manager for the Entrust Group and one of the co-hosts for the webinar today. We also have Ali and Alison Walker joining us, who will be discussing the FIRE movement and how to create your own version of financial independence. And we've invited Ali and Alison to join us because utilizing a self-directed IRA can be a financial strategy that gives you true financial independence. And we hope that y'all find the information presented in this webinar today to be valuable and informative. And we hope that you leave with some really great new ideas. Also, as a reminder, everyone is going to be on mute, but if you have questions about the FIRE movement or self-directed IRAs or anything in between except for investment advice, please go ahead and type those in the questions box on your GoToWebinar dashboard, and we will answer them during the live Q&A at the end. And also after the webinar, we will provide audio recording of the webinar to everyone in the event that you need to leave the webinar early, or if you would like to share it with someone, or if you just really loved the content that we share here today, you'll have that as a recording and it will be available after the webinar. All right, quick disclaimer before we get started. The Entrust Group does not provide tax advice, legal advice, or investment advice. So we are not CPAs, we're not attorneys, and we're not financial advisors. We do not recommend or endorse any investments, products, or services. And all of the information on this webinar today is for educational purposes only. We do recommend that you seek investment advice, tax advice, and legal advice before entering into any investment. The agenda for the webinar today will entail a very brief overview of Entrust and self-directed IRAs. Then I'm going to turn it over to Ali and Alison Walker to discuss the FIRE movement and the pathway to planning for early retirement. Then we will have the live Q&A at the end. So again, please type those questions in the GoToWebinar box on your dashboard, and we will answer them at the end of the presentation. All right, a little background on myself. I mentioned earlier, my name is Mindy Gare, and I'm the Southeast Region Business Development Manager for the Entrust Group. I've been with the company for almost 5 years now, and prior to joining Entrust, I worked for several years in the retirement industry. My main focus is working primarily with individual alternative asset investors, investment sponsors, issuers, so basically any company raising capital. I work with a lot of CPAs, attorneys, and advisors who are diversifying their clients' retirement portfolio with alternative assets, and I work out of our Nashville, Tennessee office. All right, I want to share a little background on our company for those of you joining us today who may not already be familiar with the Entrust Group. We are self-directed IRA record keepers and custodians who specialize in holding alternative assets inside of our clients' retirement accounts. And we have empowered around 45,000 investors over the last 40+ years and currently have around $4 billion in assets under administration. And one factor that makes Entrust unique is our single point of contact business model that we offer our partners and clients when they open an account with us. We do that because we understand that self-directed IRAs are a very complex area, and we like to provide a higher level of customer service to our clients and partners so that you are confident in the process and in self-directing. Most of our staff at Entrust hold the CISP designation, which is the Certified IRA Services Professional designation. We offer national continuing education classes for realtors and CPAs, and we hold national and local events and webinars similar to what we're doing here today. We also sponsor the IRA Academy, which is where we actually teach the course that trains others in our industry to pass the CISP course. Okay, now that you know a little bit more about Entrust, I want to quickly discuss what a self-directed IRA is for anyone on here who may not already be familiar with self-directed IRAs and the benefits of utilizing a self-directed IRA. I mentioned earlier that Intrust is a self-directed IRA record keeper and custodian. So I want to take a second and just elaborate a little more on what I mean by self-directed, because there are some custodians out there that say they offer self-directed IRAs, but you are still very limited to the traditional market of things like stocks, bonds, mutual funds, or potentially a very limited alternative asset. But inside of a true self-directed IRA, you're able to invest in all types of assets that are not publicly traded. So for example, any type of real estate, private equity, private debt, precious metals, cryptos, almost anything. It's not the type of IRA that dictates what you can or cannot invest in. There is some misconception around that. So I did just want to point out that it is not the type of IRA that dictates what you can or cannot invest in, but it's rather the record keeper and custodian that actually dictates what you can and can't invest in, and that's based on what they will hold. So a true self-directed IRA is a retirement account in which the individual investor or fiduciary is in charge of making all of the investment decisions. So this allows you to invest in assets that you know and understand the types of risks and returns that are going to be associated with those investments. It actually gives you full control over your retirement account. And I will say that self-directed IRAs are not for everyone, especially if you are not familiar with the assets that you are investing in, because again, you as the account holder are the fiduciary over your investments. So it's very important that you understand the types of assets that you're investing in and understand the risks and returns that are going to be associated with those assets. All self-directed IRAs are regulated by the IRC, which is the Internal Revenue Code. And here at Intrust, we hold anything that is allowed by the IRC. So we will hold anything other than life insurance, collectibles, and S corporations. That's the three limitations to the types of assets that you cannot invest in. So inside of a self-directed IRA, you are not allowed to invest in life insurance, collectibles, or S corporations. But other than that, we will hold anything that is administratively feasible. All right, now I want to introduce to y'all the co-hosts for the webinar, Ali and Alison Walker. They are personal finance bloggers specializing in retirement and financial independence. They retired in 2018 and have been blogging at alloptionsconsidered.com since 2019. In 2021, they won Best Financial Independence or Retire Early Content at the Platus Awards, which celebrates excellence in financial media. Ali and Allison have been featured in Barron's, in Market Watch, and The Motley Fool. And they've also appeared in the Queer Money podcast, the Fire Drill podcast, and Nomad on Fire podcast. They are very passionate about retirement planning, investing, and travel, and they spend their retirement with family and friends, traveling, blogging, personal finance coaching, and giving back in their various communities. Ali and Allison, I'm going to go ahead and turn it over to y'all to share with us now the FIRE movement and ways to create a pathway for early retirement.
Thank you, Mindy. And as a first segue, I wish we had known, I think we both wish we had known about self-directed IRAs when we were still working. So yeah, this is exciting stuff for us too. So we will go ahead and introduce ourselves a bit more. I am Ali.
And I'm Allison.
And we are not certified financial professionals or anything like that. We are regular people who just retired together in 2018. I was 44.
I was 54.
Allison was 54.
Yeah. And I worked in the printing industry. My job was a digital retoucher, and I worked for a lot of large retail clients to produce catalogs that we used to all get in the mail.
And I was working as a business development manager, marketing manager for engineering firms. And that's not software engineering, that's architecture, engineering, environmental science, that sort of thing. So we were not working in money. We were just working in sort of the other creative jobs. And engineering arts, yes. And our blog, All Options Considered, is not a business. It's not intended to be our new post-retirement jobs. It's really our passion project, our hobby, and our way to meet people.
And give back to our community. We're really passionate about financial literacy, and we're finding that with families and friends and new people that we meet, we get to help expand that concept.
So, oops.
There we go.
So FIRE, what is FIRE? And if you already know what the FIRE movement is or what financial independence is, feel free to throw that into the chat. We're always curious about that. If you have no idea what FIRE is the financial independence retire early movement. Some people think of it as a movement. We think of it as just really innovative retirement strategies, which are sometimes contrarian, or they're contrarian to some people. And we find that in the FIRE movement, some of us, including me in particular, it's really all about retirement. I wanted to retire as early as possible. And so for me, it is about retirement. But to be fair, it's not for everyone. And for probably most people, it's about learning how financial independence is just a concept that you can take and then make it your own and turn it into whatever you want it to be in your life. And the question a lot of people want to ask is, can everyone reach FIRE, become financially independent and retire early? The answer is no, of course not. Many people just have too many obstacles in their financial lives to be able to get there. So it's really not available to everyone, which is unfortunate, which is why spreading information about FIRE feels so good to us. But the real point of the FIRE movement, the thing that we struggled with for so many years, was how to figure out if you really have enough money so that you can retire and stop working forever and trust your portfolio to do its job.
Yep. So we all have, or there has been many different ways to try to figure out if you can retire early. Everybody's been trying to break that code. The thing that's been interesting about the FIRE movement is it really kind of distills down to there was this book, there was this white paper, and then there was a study. And after that, the content creators took off, digested all this new information, because lots of other people were trying to figure out how to retire and crack that nut. But if we go back and look at the evolution of the FIRE movement, these are the three elements of information that people distilled, digested, and internalized to make their early retirement possible.
So the first of those being this book, and again in the chat, if you already know about this book, if you've already read this book, it would be fun to know that. If you haven't, we would recommend it. The book Your Money or Your Life was published originally in 1992, which kind of sounds like a million years ago to me, but it really was very recent. The book was written by Vicki Robin and Joe Dominguez, a wonderful couple. The types of things, and they had been trying to get this information out through different kinds of events, but eventually they got to this book, and this book really did the trick. It really brought the information to as much of everyone as possible, where they really explained how to demystify Wall Street and make investing feel more comfortable for regular people like us. And also the book talked about the value of personal money management, which is different from having a professional money manager, just knowing that we as regular people can manage our own money. And also talked quite a bit about the negative consequences of consumerism, which I think that was pretty new information. And that was the type of thing that got the attention of people like Oprah Winfrey. So Vicki Robin took this book on the Oprah show. And the really shocking advice in this book that really got media attention was, this is shocking. I mean, this really is shocking advice: to spend less, to earn more, to save as much as you can, and retire early enough to enjoy your life.
One of the other things that was interesting is Vicki had said back in that time that we were no longer citizens, but we had become consumers. And that was a really interesting point that she had made. when they were writing that book. All right, let's jump into this white paper. So there was a financial advisor named Bill Bengen who was really interested in finding out if he could answer the question for his clients, how much can I withdraw from my portfolio and have it last long enough, at least outlast me? So he did some work, crunched some numbers, and published this white paper in the Journal of Financial Planning back in '94. And what he did was he back tested all of his clients' portfolios over the 75 years of historical stock data. And he came up with an inflation-adjusted 4% withdrawal rate if folks were having about a 50% equities, 50% bond ratio in their portfolios. And that typically lasted everybody about 30 years. The problem now is we're all living longer and we're trying to retire earlier, which means we're going to live longer. So this has become kind of a standard of where to start evaluating whether or not you have enough money, if your portfolio is large enough, and if your expenses can be supported by your investments.
And the third thing in that kind of core building blocks grouping is the Trinity study, which, you know, people in the FIRE movement have read all of these things. So the Trinity study is another one of those things. I don't know if I can really recommend, like, please read this. If you like reading this kind of stuff, read it. It's interesting. It's only a few pages. And of course, it was written for financial professionals as well, which makes it harder for some of us, but it's worth reading. So the Trinity study came out in 1998. It was conducted by 3 professors of finance at Trinity University in Texas, which is why it's given that name. And this also looked at this grouping of 15 to 40 year time horizons of historical data, different types of allocations ranging from 100% bonds to 100% equities and everything in between. And it also reviewed different types of withdrawal rates, maybe 3%, which is a number that's familiar to us, as high as 12%, which sounds frighteningly high, at least to me. The study also looked very closely at Bill Bengen's 4% withdrawal rate and noted its success rates for historical data. And when people in the FIRE movement tend to read the Trinity study, from our perspective, it seems like they're seeing this as proof that the 4% rule will always work. That's not what this is. What this is a really interesting study that proves that your success rate will be higher if your equity allocation is higher, if your withdrawal rate is lower, and if your retirement time frame is shorter. So that's what the Trinity study really brought about.
And then the last part of kind of the FIRE evolution in its prominence at this point, where the content creators came online about 2010 and started digesting and finding all this information and turning it into their own versions of how to run the 4% rule or how to apply some of the concepts about money that Joe and Vicki were putting together. And originally, most of these influencers came from the Silicon Valley, a lot of the tech bros, and part of that was because they were making a lot of money and they really wanted to start surfing versus coding. So that tended to be, you know, some of the topics that they were covering. So what they were doing is they started taking some of the innovative investment approaches, for instance, Jack Bogle and Vanguard and their low-cost index funds, and applying those to the 4% rule and the fact that they could be investing directly versus having to go through some sort of stockbroker or whatever. So they had online access themselves. So they started to take over the control of their portfolios. And at some point then, we, you know, fast forward another 10 years, and here we are now. And what we're seeing is it's moved from a lot of the high income earner people creating content to a lot of folks people of color, a lot of LGBTQ people and women, all taking these FIRE concepts, the innovative investment strategies, and making it their own and applying it to their own situations and lives.
So this is really where it takes off, I think, for us, because the book I mean, the book was getting popular, but the study and the white paper, that drew in more and more people who were already working in money. So there are a lot of people who were working in money and then got into the FIRE movement. But the content creators as the content creators grew and evolved, that's how the FIRE movement really took off. So what are the basics of FIRE? The basics of FIRE are really, you can FIRE at any age if you have the money. And the more you save, the earlier you can retire. That's definitely true. One thing that we want to make sure is in here towards the top of the list for any list of basics to FIRE is having a really accurate post-retirement budget. That is critical. And that was what helped us. That was what kind of made us take a longer time figuring this all out. Because how do you figure that out? It's complicated, but you have to have real numbers to do the math. And then, of course, there's a lot of talk about debt. So consumer debt, of course, can block people from FIRE, but good debt, like, you know, owning real estate and having mortgages, that's actually a great way to build wealth and get yourself to FIRE. And then, of course, also critical that the income and growth from your investment portfolio, whatever that might be, it should never outweigh your spending. Your spending should always be lower, hopefully substantially lower than the growth of your portfolio. And then the bottom line really is that FIRE with early retirement is about letting your portfolio and whatever you've invested really do the work. So you can stop working and you can focus on what you love and what you care about and what's important to you. And your money is still over there working for you.
Okay, so the big question is, how much money do you need to retire early? So using the 4% rule, you can take whatever portfolio you have right now and divide it by 4%, see what potential income would be throwing off of that particular portfolio, and decide if that coincides with your budget. If it doesn't, then you probably have to save a little bit more. But if you want to kind of flip that around and you know your budget a little bit more, you can take your budget, times it by 25, which is the inverse of the 4% calculation, and that will give you the portfolio value that you need to be targeting. So as an example, let's say you've got a $2 million portfolio. If we throw the 4% rule at it, then you would be having $80,000 of income and potential growth to live on every year if you're following the 4% rule. If that feels a little bit too much and you want to be a little bit safer, you can move on down the line and you can try 3.5%, which the inverse of that is 25 times. So you can see on each of these 3%, 33 times, Allie and I went for that target because it was a little bit more conservative and we weren't pulling out as much money from our portfolio. But here are multiple examples of basically you either times your expenses by 25, 29 times, or you look at your portfolio and divide it by nothing more, hopefully, than about 4%.
And we really want to encourage people to look at it this way, because if everyone just goes with 4%, it's not a perfect number for everyone. So you want to slide down the line and keep finding the number that works for you. So this is sort of a funny thing. What are the types of FIRE? So there are different types of FIRE, which really just means people are coming up with ways to make these concepts adapt and feel comfortable to you specifically. So these are the terms that are really common. We don't necessarily love all of them, but they're pretty common. So the first one is lean FIRE, which basically, from our perspective, is just straight back to the 4% rule. You've saved 25 times your annual expenses. And generally people in the lean FIRE category, they spend less than the average person. They might have a medium to lower income, and they're probably living in a lower cost of living area. Then there's fat FIRE, which I really don't like that term, but then we'll tell you why. So fat FIRE for most people means you can retire once you saved at least 30 times your annual expenses. And it could be quite a bit more than that. And these people generally, they spend more than the average American. They might have a higher income, they might live in a higher cost of living area, but please note that this is not just for surgeons and the highest income earners. We're in this category, which is why I'm always thinking, I don't like that term very much, but this fat fire concept, it just works for average income earners with average spending habits who are a little bit more risk adverse and think 4% is not safe enough for us. So then there's barista fire, which now that's kind of a fun term, though some people don't like that either. But what that basically means is you've saved enough to quit your full-time job, and the growth from your investments is enough to cover at least part of your expenses, but you're going to continue to work. You're going to continue to work and have some kind of active income generating, which could be a part-time job, it could be a side hustle. Maybe you're making, your own mugs and selling them on Etsy or anything like that. But basically, you have to continue working at least part-time, hopefully also taking advantage of benefits from an employer so that you can wait until you're full on fire and you can quit. So then there's Coast Fi. Now note, this is Fi, this isn't fire. So Coast Fi is very popular, really a cool concept. It means that you have hit your principal number for fire. So thinking about the math that Alison was talking about, you've hit your principal number, and that means you've invested enough to be able to stop working forever, but your portfolio needs time to compound and grow. So whatever your portfolio is, whether it's investments or real estate or whatever it is, you need to kind of put it in the oven and let it bake, which means that you still need to be working in some fashion to cover your expenses while you're waiting. And then of course there's Slow-Fi, also a very cool concept. And now Slow-Fi this is for everyone. So this is about taking the financial independence mindset, making it your own, focusing on your own long-term financial stability and living according to your own financial goals, your own personal money values. So this is the one that's for everyone. And then what are the common paths to fire?
Well, getting to the math, we're going to have to build up that portfolio. And what's going to be most important is that regardless of which of these paths you want to take, whether it's market investing, real estate, entrepreneurship, you're going to need to be able to take control and pick those things that you can be consistent with and that you understand. If you're not able to be consistent and understand the things that you're investing in, the likelihood that your portfolio is going to grow the way you need it to is going to reduce. So for instance, if you're going to invest in the market like we do, you're going to probably be going after low cost investing in mutual funds or ETFs to help control your expenses and keep more of your growth. If you're going to go into stocks, which there are lots of people who do, understand the risk profile. You certainly will have a much more volatile profile the fewer stocks that you hold versus if you're holding, for instance, a broad market ETF. If you're holding real estate, make sure you've got some great cash flow coming through. It's a business, remember that. If the numbers don't work out and don't math out correctly, then you need to move on to something else that does. You want to make sure you have good ROI because it is a business that you're running basically. Entrepreneurship, start a business. Lots of people are doing it. Lots of people have online stuff that they're doing. It can be full-time, part-time, or even hands-off. And again, positive cash flow. If it doesn't do that, don't waste your time. Move on to something else that you understand and you can be consistent with and keep growing. Another element that's really interesting regarding the FIRE movement is that there's a bit of frugality in there. I read a story about a coder down in Silicon Valley who was actually living in a panel van in the parking lot of the company he worked for.
And this is a very high income earner.
Yeah, so from my perspective, that's a little too frugal. But understanding the demands on your portfolio and moderating that through some level of frugality and awareness of your expenses is another thing that helps propel you forward regarding your portfolio and the math. And then we also know a lot of people that are doing a little bit of each. We have some friends that have 3 online businesses. They're starting to get into rental real estate and they own a brokerage account and own stocks. So they're doing all 3. And that's how they're building their path to FI.
Let's see. So
the other things that we've figured out after a couple of years of doing some coaching and blogging and working with other people in the FI community, other content creators, is Allie and I have kind of distilled down the whole process of figuring out your FI path, and then it has 3 elements to it: understanding your emotions, planning and organizing for the future, and making sure that your money is working for you.
So the emotional side, we like to spend a lot of time on that because I think that's neglected by a lot of people when they think about money and retirement. So we really like to talk about that and get people to think about that. So what we know for sure is our emotions impact our spending. And we really want to encourage people to try to be aware of how their experiences around money and the way they feel about those types of things, how that might affect their retirement planning. For example, we've talked to lots of people who are interested in financial independence, but because of all kinds of emotional experiences and issues, they have no interest in retirement because it seems too scary, or it takes away their sense of purpose, or whatever it might be. So whether your emotions are talking to you about that, or if you're someone like me who had kind of early childhood poverty, sort of money trauma, I still think about those kinds of things when I go to, pay for something. Oh my gosh, what if my card's going to be declined or something? Those kinds of things, I carry them with me. So we want to talk about that and get people to think about that. And we want to encourage people to really let go of any money shame. We want to especially encourage people to just buck tradition and do what's best for you, and really pay attention to things like if you have any family responsibility, if you have kids, if you have parents or siblings or anyone that you at least have some responsibility for financially, to pay attention to that. And we also, lastly, want to encourage people to sort of, it's okay to talk about money. So if you're interested in this type of thing, do create a community for yourselves, at least a friend or two that you can talk to about these types of things. It makes a huge difference.
So the other element of this is your planning and organizing.
And, that sort of comes down to, for couples, we're all different, right? So for couples, you want to make sure you're in communication and you're hopefully working towards the same goal. Though honestly, we meet people all the time where only one half of the couple wants to retire now or soon, and the other person is really not interested in that. But the idea is to be in good communication, and if possible, be working towards the same goal. And if you're a single person, FIRE is still yours. Financial independence is still available to you. The first thing you want to do is focus on your safety net, since you don't have a sidekick who can also go back to work if something should happen. For those types of circumstances, focus on your safety net before you get too far down the road. And then for everybody, do think about lifestyle changes if you're planning for FIRE, because we all have a routine, we all have priorities, we all have hobbies, and they change over time. So your life while you're working and your life after retirement, they are not identical. So think about that. Also, for all of us, we're originally from California. We moved to Seattle, and that's where we reached FIRE, and now we live in Arizona. Location and cost of living are huge factors, of course. And so just a reminder, you're allowed to move. And then also the question of renting or owning, and we've gone back and forth on this, and you can rent or own at different times in your life, but the most important thing, I think, is just to know that you're allowed to do both. Renting is just as much of a success decision as owning a home today. And of course, plan for healthcare needs and costs, because that is a huge part of your FIRE number, is being able to pay for healthcare without an employer. And lastly, it's really never too early to prepare for old age and your end of life, and think about, are you going to be in your own home? Are you going to be paying for someone to come in and help you? Are you going to live in a retirement community? Are you going to buy into a life planning staged type of facility. So just plan for those and put them in your plan early.
Okay, so now we'll talk a little bit about the money and math. And as you can see, there's more than just money and math, as Allie's just gone through. So some of the important elements about the money side of it, of course, save and invest as much as you possibly can. Do what you can to try to, switch positions, maybe earn a little bit more, maybe add a side hustle, depending on where you're at with your ability to earn income. The other thing too is to make sure that you're keeping track of that low cost portfolio. Keep it organized. Keep on top of it, whether it's real estate investment, stock market stuff. If it's not a good investment anymore, it's go ahead and switch to what's better. Buy a house, buy a rental in a better market, or move to a different allocation in your portfolio, equities to bonds, depending what your risk profile is. And again, down below there, that's understand your risk tolerance of the market. They say that the people who make the most money in the stock market are people who, I'm sorry to say, are dead. And that's because they don't make a lot of changes. They don't allow their emotions to control them when the market goes down. The other thing to do also is to outline your withdrawal strategy from start to finish. Retirement's a long time. You'll have different accounts, different balances, and different needs depending on your age. So understanding what you have available and what to work with. For instance, Allie and I have a brokerage account, 2 IRAs, and 2 Roths. And we have been looking at those for what we're going to need first, second, and third, depending on what stage of retirement we're in.
Which means for early retirement, it's all brokerage account.
Correct.
And she's 10 years older, so then we get into her IRA and so on.
Yeah. So balance the accessibility of your funds along with the long-term growth objectives. So the other thing, we've been talking a little bit about this, is make sure you have a realistic budget. Probably a lot of people have heard of the go-go, slow go, and no-go periods of retirement. And it all has to do with your age, your health, and the demands on yourself and your portfolio at those different times. So even though you have a budget right now, there will be different demands on it in the future. And one of those is healthcare costs.
Just plug that one more time.
Plug it
Don't
again.
ignore it.
For instance, you might decide if you've got kids that maybe your kids are going to help take care of you when you're older. We don't have any kids, so we know that we're going to have to. We have nieces and nephews, but we know that we're going to have to be primarily responsible for our costs in the future. So we have that built into our plan. The other thing that's really interesting is make sure you're considering taxes all along the way. A lot of people are focused on saving the most in taxes in the current year, and they lose sight of the lifetime tax obligation that they have. And the best example I can give you for that is, when you turn 72, if you have big IRAs, you're going to have to start withdrawing those RMDs. It could create a huge tax obligation down the road. So what can you do now and pay a little bit more in taxes now to reduce that in the future? And what we're doing are Roth conversions from our IRAs to our Roths, paying a little bit more in taxes right now, as well as healthcare premiums, because we're on the ACA in Arizona, which will reduce our obligation in the future. The other thing that we found that's been really interesting is if you are going to inherit any money of any kind, pay attention to that. Because for a bunch of reasons. It will affect your plan, it could affect your taxes, but also where are you going to invest that? How are you going to use that to support your future retirement?
And remembering the money, the emotional side, we're always surprised at how many people say, yeah, I'm going to inherit, but I don't want to talk about that and I don't want to put that in my plan. It happens all the time.
Yeah, people say, I'm embarrassed, but it's something that you need to pay attention to. It's okay to say, I don't want to necessarily 100% factor that into my calculation, but you need to be aware of it. Just like Social Security, everybody thinks, oh, there won't be Social Security down the road. It might be there, it might be less, but you need to pay attention to it. And finally, we have in our plan, plans for giving. We do giving every year, And we also have nieces and nephews. So if there's anything left, and I hope there is, we're planning on passing it on to them. So we include that in the money side of our planning.
And last but not least, we just want to encourage you all to make your own plan and make it yours, because there's really no one size fits all retirement plan. There's no one size fits all anything in money or in anything else, but especially not in money.
And decide on what your safe withdrawal rate is. Be reasonable, be realistic. Don't overplan for maybe growth in the stock market. Don't overplan for, the appreciation of a rental property. Be realistic.
And set your own timeline and age for quitting work. I've mentioned I was able to retire at 44. If it had been earlier, that would have been fun. So for me, earlier is better. We meet so many people who have interesting feelings about retirement. The point is, you pick the age. You want to retire at 40, 50, 60, 70, never. It's your choice, or at least we hope it will be your choice.
And your FIRE number is based on your circumstances. How much money you're making, what your other responsibilities are. But whatever you do, build your FIRE plan that supports your hopes and your dreams and your goals. And that's our conclusion for our presentation today.
So we can toss the ball back over to Mindy, I think.
All right. Well, thank you very much, Allie and Allison, for that very enlightening information on the FIRE movement and the innovative approaches to creating your own financial independence. That does conclude the FIRE movement webinar for today. But before we dive into the live Q&A for those that don't have time to stick around, just so you know, we do have another webinar coming up on August 17th. The topic is still to be determined, but you can visit our website for updated topics and to sign up if you are interested in participating in that webinar. If you would like more information on the FIRE movement or information on self-directed IRAs, I believe the next slide has all of our contact information. So you can reach out to Allie and Allison. I believe their contact information is on the next slide.
There we go.
There we go. And then if you have questions in regards to self-directed IRAs or wanting to discuss some potential investment ideas or rules and regulations, feel free to reach out to me. My phone number, email address. You can also visit our website and Learning Center for a plethora of information. And also feel free to follow us on social media for all relevant industry updates. All right. So now we will, actually one more quick reminder. If you want more information on today's topic, there is a brief webinar survey at the end. We do love feedback on topic suggestions. So we do have a 2-question post-event survey when you exit the webinar. So if you have a few minutes to spare, we would really appreciate it if you could complete that. And also, just as a reminder, there is a recording of this webinar that we will be sharing with everyone after the webinar concludes. All right, I'm going to go ahead and open it up for the live Q&A. So let's check the box to see if there are any questions. All right, we do have the one question so far. The question is, are your math calculations based on singles or couples?
Our math calculations are personalized to everyone.
Yeah, I think your budget should be set for, you either as a single person or a couple. And then if you go back to doing a 4% rule calculation on your portfolio and your result ends up being above or below that budget, then that's how you then determine. It's kind of budget based, not necessarily singles or couples. If that makes sense.
Yeah.
I mean, we know a single person who spends $75,000 a year, and we know a couple with a family of 4 with 2 little kids, and they're spending $30,000 a year. So
everyone's different.
Everyone's really different.
So we've built our own spreadsheet, and we run numbers for ourselves and for friends who reach out to us, and it needs to be individualized for anyone.
Yep.
Hopefully that answers your question.
Yeah, thank you very much. Doesn't look like there's any other questions coming through right now. So let's go ahead and give it about another minute for anyone who would like to submit a question. And then if we don't have any more, we can go ahead and wrap up the webinar.
I know it was a lot of information. It's a pretty deep topic and really kind of pushes the boundaries on a couple of areas, both, you know, emotionally and financially. So,
And this really is an overview. We would be very happy to get into gory detail with anyone if you want to reach out to us, but it looks like there's maybe another question.
yeah.
Yep, it looks like we do have one more that just came through. And the question is, how do you think about tax stuff on a very basic level?
So we have a couple of kind of guardrails, shall we say, that we have to pay attention to throughout the year. We're both looking at taxes with regards to the individual tax brackets for how higher income is. And then we're also looking at the ACA healthcare plan to see if there are any income limitations regarding that. So, of course, we'd like to pay fewer taxes so we can manage our budget a little bit better, but we're also trying to achieve some other goals during the year regarding, like I said before, about doing a Roth conversion to reduce our lifetime tax obligation. And
so I think the interesting thing is we try to pay attention to taxes for this year and for the lifetime hand in hand. And we are prioritizing our lifetime tax obligations over, in a sense, over our this year tax obligations. And because for us, Roth conversions are a huge priority, and for reasons Allison explained, but also we are on the ACA in the open marketplace, and we don't want to pay, you know,
high premiums.
$4,000 a month
Right.
on premiums or something like that, which we actually could. So we also pay attention to taxes for those reasons as well.
Yeah, and it is true that you know, we're estimating our taxes, and we know that the tax laws are going to change coming up here in the future.
I think
So
in 2026.
Yeah, we're doing our best guess at this point.
Okay, and then I believe you already answered this, but the same individual asked a follow-up question, and that follow-up question was, you mentioned thinking about how to minimize future tax obligations.
It's basically understanding that at certain moments in your lifetime, 72, let's say, start out with that there are other things that are going to start occurring. And additionally, you know, when you're 65, Medicare starts. If your income is over a certain amount, kind of a hidden tax that you could consider it a tax is your IRMA obligations might go up if your income is higher. So paying attention to those types of things is what we're looking at, not just the next 5 years. We're looking all the way out to end of life.
Because if we weren't doing Roth conversions, our IRAs are, you know, since we're living only on our brokerage account in early retirement and our IRAs are pretty big, we can see by projecting and doing models on our own portfolio that once we hit RMD age, we're going to be in a very high tax bracket. So let's get higher taxes today, work on Roth conversions today, and make sure when we're elderly old people, we don't have the highest tax bracket.
Yeah, because things like RMDs will throw you into a higher tax bracket and could potentially trigger things like IRMA.
All right, thank you for that great insight. There is another question that just came through, and the question is there a specific investment class, for example, rental properties, which are better to achieve FIRE earlier? And again, just as a reminder, we do not provide investment advice.
Right, and just as a reminder, we do not provide investment advice, but wanting to play along.
I will say that we know people who have achieved pretty early FIRE doing both. You know, we have seen people who have multiple rental properties, like 7, and they're doing great. We have other friends who have invested really well and gotten really lucky in the stock market, and they're retired early. So I think like I said a little bit earlier, if you're following your philosophies, if you're following your guidelines and you've picked an investment strategy that you can stick with and you understand, you're going to do great.
And I would add, just for, just to be transparent, we wanted to educate ourselves on investing as much as possible. So we started with individual stocks, and then we saw how much this is upsetting when the stock value is going up and down wildly all the time. So we switched to owning a couple of rental properties. And we were the example of people who, we ended up kind of needing to charge under market value, and we did not make a fortune with rental properties. So then we switched to index funds and ETFs specifically. So that's just our progression. And as Alison mentioned, we know people like, I'll throw out Paula Pant. She's the person that we would want to go back and focus on what she's learned about real estate. If we were going to get back into real estate, we would look at Paula Pant. We know people who are dividend fire people, and they're all about individual stocks, and they're totally successful that way. And again, we now are 100% index fund ETF, but we didn't get there that way. That's just that's the class we chose after retirement. So the answer is it depends, and it's up to you.
It's up to you.
And they are all good options.
All right, thank you very much. All right, it does not look like we have any other questions coming through. So we will go ahead and wrap up. But again, if you do happen to have questions in the future, please go ahead and write down our contact information. And again, this webinar will be, we will be posting a recording on our website. And I believe you will be emailed a copy of the recording as well. So thank you all very much for joining us today. And thank you very much, Allie and Alison, for joining us and sharing all of your wealth of knowledge on the FIRE movement.
Thank you. It was a pleasure.
Thank you all. And please do reach out to us. We would love that. And thanks again, Mindy and everyone at Entrust.
Thank you. Y'all have a good day.